Hi everyone. Thanks for joining us today. So we'll probably wait for a few more minutes for more people to join before we start the webinar. Okay, good afternoon everyone. Thanks for tuning in to learn more about CFDs, which stands for Contracts for Differences. Without further ado, let us begin. So during this webinar, if you have any questions, right, please feel free to leave it down in the Q&A section below. And after the webinar, I will address your questions. This is the content outline for today's webinar. So, what are CFDs? CFD is an agreement between two parties to settle the difference between the opening and closing prices of the contract. They are traded over the counter. So in this case, it will be a contract between you and PhillipCapital. CFDs are actually derivative products, and their prices track the underlying asset closely, allowing you to participate in the price movement of an underlying product without actually owning the assets. So now you must be wondering, is there any difference between CFD and stocks, and which should you trade? I'll say here that will actually depends on your objective. Here, I'll highlight a few differences between CFD and stocks. Firstly, ownership of assets. For stocks, you have ownership over the asset, but for CFD, you do not actually own the asset. This means that you are not entitled to any voting rights if you trade CFD. Secondly, ability to short. Stocks is only one directional, as you can only buy, but for CFD, they are bi-directional, meaning you can either buy or short sell. Hence, CFD is not restricted by the market direction, and you can take advantage of the rising market by taking a long position or shorting in a falling market. This gives you greater flexibility as you can short without having to borrow shares. And this is applicable to all the products that we are offering, be it equities, commodities, indices, or FX. Thirdly, leverage. CFDs are leverage products. So you only need to put up certain percentage of the total contract value in order to establish and maintain a position. This percentage varies for different counters, which you can actually get this information when you open a CFD order ticket. This will give you the advantage of enhancing your portfolio with the same amount of money, since trading stocks will require you to put up the full contract value in order to open the position. Lastly, finance charges. As you do not have to put up the full amount for the contract, this means that PhillipCapital is actually loaning you an amount to establish and maintain that position. Hence, these positions will be subjected to what we call finance charges when you hold those positions overnight. I'll be further elaborating on this in the later slides. Now we will talk about the advantages of CFDs. As mentioned, you can use CFDs to establish a short position. It gives you leverage. There are multiple asset classes that you can trade, and CFDs can also be used to hedge your existing positions. Now, I'd like to explain more about leverage, which is also known as margin trading. We learned that CFDs are leverage products. You only have to put a certain amount of deposit to trade larger positions. Here, a relatively small market movement can have a proportionally larger impact on your deposit. This means that leverage can actually amplify both your returns and losses, as there's a possibility that you can lose your entire deposit, or even more, should the market move against your favor. Now, let me show you an example. So what you are seeing on the screen is that you can see that the margin required to buy one Amazon share CFD is 10%. Now assume that the price is $3,161. The value of 10 Amazon shares will be equivalent to $31,161. Now, instead of putting up the entire $31,161 to buy 10 Amazon shares, you only have to put up $3,161 to buy 10 Amazon share CFD. Note that this amount is actually equivalent to just buying one Amazon share. Now, this also translates to a 10-time leverage. Now, let me show you a table which will illustrate the difference between trading CFD and stock. From the table, we can see that for the same contract value, the initial outlay required varies for a CFD and a stock position. And if we were to close the position at the same price, the return on equity is much higher for the CFD position as compared to a stock position for both profit and losses. As illustrated in scenario 1 and scenario 2, when you see that if you're just trading stocks alone, it will just translate to either a 5% loss or a negative 5% gain. But for the same position, close at the same prices, for CFD, it actually translates to a 50% or negative 50% ROE. Hence, I'd like to reiterate that leverage is a double-edged sword. Even though it can increase your returns, it can also amplify your losses. So please take note when you are trading using leverage. Next, we'll move on to the different products offered by PhillipCFD. So firstly will be our equity CFDs. They mirror the cash market price movements at no additional spreads, meaning that the price quoted for equity CFD is the same as the stock market. As shown in the screenshot below, where you can see that the prices for UOB for all three products are actually at the same prices. The margin required varies for different counters, but it can go to as low as 10%. We offer equity CFDs from 8 global stock exchanges, with over 1,500 counters in both the SG and US markets. Next is DMA CFDs. DMA stands for Direct Market Access, and this is only available for the Singapore equities market. DMA CFD provides investors with direct access to the exchange. So clients will be able to enjoy the various features such as taking part in the pre-opening and pre-closing sessions, participate in the market liquidity and order book of the exchange. Orders are also done based on the last done price based on price time priority. The margin required varies for different counters, but it can go to as low as 10%. So here we'll highlight the difference between CFDs and DMA CFDs. So we can see that for DMA CFD, orders are routed straight to the exchange, and they are done based on the order book of the exchange. And for DMA, as mentioned earlier, is only offered for Singapore equities. Then next for CFDs, the orders may or may not be reflected in the exchange. And the orders are done strictly based on the bid and ask prices. But for the advantage of CFD as compared to DMA is that you are able to enjoy lower commission rates. So something I would like to add here is that since we offer CFD and DMA for Singapore equities, do take note that a CFD order cannot be used to close out a DMA position, and vice versa, since they are different products. This also means that you have the flexibility to open opposing positions on the same Singapore counter in the same CFD account, thus hedging your position. I'll explain more about this later. Another asset that we are offering is commodity CFD. We offer products on the most frequently traded commodities, such as your gold and silver. And we also recently launched our UK and US oil products in March. So stay tuned to the end to find out the promotion that we are offering for trading our oil products. There's no expiry for our commodity CFD, and the margin required can go to as low as 20%. For clients who are interested to add commodities to their portfolio, but at the same time who do not want a huge exposure to this product, they can also consider using our mini contracts to trade or diversify their portfolio. We also offer the World Indices CFD on major indices such as the S&P 500, the Hong Kong Index, and many more. We offer multiple contract sizes to cater to the different needs of our clients, and the margin can go to as low as 5%. This product can provide huge advantage to clients who like to invest in many counters but have limited capital. Our index CFDs are either cash-derived or cash-correlating. Cash-derived indices CFDs are derived directly from the underlying cash index, while the value point of the cash-correlating indices CFDs may differ from the underlying cash index, but are still relatively correlated. Indices CFD are extremely useful contracts to add to your portfolio, as you are exposed to the stock market performance without having to buy the individual counters that make up the index. The chart on the slide shows how you can take advantage of the indices movement by buying a contract when you have a bullish view and selling off when the price rises. Let's take a look at the contract specifications of an index CFD to understand more about the product. What you see here is the contract specifications of our Straits Times Index SGD5 CFD. So from the name, we can actually identify that the value of one index point of this contract is equivalent to Sing $5, meaning that a point increase will result in a $5 increase in your contract value. The initial margin and the maintenance margin required is the same at 5%. The trading hours are as stated, and the target spread of this product is 3.6 points. This means that we aim to keep the spread of the product at 3.6 points between the bid and the ask price. But do take note that this is subject to variation and may not hold true, especially in volatile market conditions and out of trading hours. Now, suppose you buy one contract of STI5 CFD at 3,300. The contract value is basically 3,300 multiplied by the value per point, which is $5 in this case, amounting to $16,500. And you only need $825 to gain exposure to the stock market performance, which is ideal for people who have limited capital and do not want to be exposed to a single counter only. One of the latest additions to our suite of products is our FX CFDs. We provide access to more than 30 major global FX pairs, and our product tracks the performance of the underlying spot forex. We offer in mini sizes at a contract size of 10,000 in the base currency of the pair, and clients enjoy 20 times leverage for trading our FX CFDs. Let me dive deeper into the basics of FX CFD for our audience who may not be familiar with this product. In an FX pair, we have a base currency and a term currency. When we enter a buy or sell trade, we will always refer to the base currency, and the opposite transaction will take place in term currency. So in this example, if we are buying GBP USD, we are buying pounds by selling USD. This is how we'll understand the quote. When GBP USD is quoting at $1.30, this means that 1 pound is equivalent to $1.30 US dollars. Do take note that the profit and loss will always be reflected in the term currency, which is USD in this example. Next, I'll introduce something that's unique to trading forex, and that is swap points. Swap points arises from the difference in the interest rate between the currencies bought and sold. When you trade forex, you will earn an interest on the currency bought and pay the interest on the currency sold. So when one holds a FX CFD position past overnight being 6 a.m. Singapore time, the FX position will gain or lose swap points. And this gain or loss will be credited or debited from your CFD account as a swap point adjustment. Next, we'll move on to the mechanics of trading CFD. So how is a CFD order done? CFD orders are done based on the prevailing bid or ask prices. So when client submits a buy order, the buy order will only be done when the price submitted is equivalent to the prevailing ask price. Similarly, a sell order will only be done when the price submitted is equivalent to the prevailing bid price. So a sell order will only be done when the price submitted is equivalent to the prevailing bid price or even lower. And for the buy order will only be done when the price submitted is equivalent to the prevailing ask price or higher. Hence, for CFD orders, we only focus on the bid and the ask price. So this is the process flow of a CFD order. So I'll leave this up for a while for you all to read through. And if you have any questions, please feel free to leave it out in the Q&A section, or if subsequently you have any questions, you can check with your trading rep or call in to the CFD desk. Next is the order execution for DMA CFDs. Since the order is routed to the exchange, you'll be able to see your order on the exchange order book. So this is the market depth before your DMA CFD order. Suppose you submit a DMA CFD buy order at 0.85 for 1,000 shares. You'll see that the market depth now has been updated, but the buying price of 0.85 has now increased by 1,000. Of course, all these transactions comes at a cost. The first cost will be the commission charges. Commission is charged on both the opening and closing of CFD positions, just like your normal equities positions. In this case, the amount charged is based on the total contract value. The advantage here is that equity CFD trades done on the same day for the same counter and contract type will be amalgamated. So this feature is extremely beneficial for clients who do multiple small trades within the day, whereby those trades fall below the minimum commission chargeable. Our commodities and world indices CFD are charged on per site, per contract basis, and we do not charge commission for our FX CFD trades. Another cost that comes with CFD transactions are financing charges. Finance charges are charged to overnight positions, and this is accrued on a daily basis and will only be realized upon the contract rollover or the liquidation of the position. This means that there are no finance charges for position open and closed within the same trading day. FX positions are also not subjected to finance charges, but they will be subjected to swap points adjustments as explained earlier. So now I'll illustrate the calculations of the finance charges. The daily finance charges are calculated based on the formula shown, market value multiplied by the financing charge of that particular contract divided by 365. So for example, a client opens a long CFD position on Amazon and closes the position on the third day. The market value for day 1 and day 2 is 31,000 and 35,000 respectively. To find the total finance cost of the contract, we'll have to find the finance charge on day 1 and day 2, which is $3.40 and $3.84 respectively. The total finance cost charged to the client for this position is therefore $7.24. Now, Since CFDs are traded on margin, clients may be subjected to a margin call. Margin call is issued when the equity balance, which is the total asset in your CFD account, falls below the required maintenance margin. Usually, this will happen when the market goes against your favor, such that your unrealized P&L is so huge that it depletes the available cash in your account. The equity balance and the maintenance margin figures will be calculated using the previous day's closing prices. And clients will have 2 business days up to 3 p.m. on the second day to fulfill the margin call. The exception in this case is that when your equity balance has fallen below 5% of the market value of your portfolio, then you'll be directly issued with a day 2 margin call, such that you have to fulfill the margin call by 3 p.m. on that day itself. So in the event when you receive a margin call, you can either deposit funds or liquidate sufficient positions to satisfy the margin call, so as to prevent a forced liquidation of your positions. Now, you must be wondering what you can use CFDs for. So you can use CFDs for your basic trading, and CFDs are suitable for clients who have varying needs. Clients can use CFDs for long-term investment with small upfront capital. It can also be used for scalping, for clients who want to take advantage of the short-term price movement with enlarged trading power. Lastly, it can also be utilized for sophisticated trading strategies, such as arbitrage. Another use of CFDs is hedging. Clients can hold opposing positions concurrently to protect against adverse price movements, thus protecting their long-term positions from short-term volatility. I'll demonstrate how you can use it to hedge your position. Now, assuming client A bought 1 lot of ABC shares at $25 on 3rd December, but the price tumbled down afterwards. What can client A do at this point, assuming a bearish market? I think it's safe to say that at the point of time, our first reaction will always to observe and hope for a reversal. However, the prices kept falling, and in this case, client A decided to sell it off at $23. The losses resulted from the difference in the price movement here will be $2,000, and the cost will be the commission for both opening and closing trades, amounting to $128.40. And exchange fees payable is $19.20, which the net loss resulted from this position is a total of $2,147.60. Now, what if I tell you that you can actually take advantage of this bearish movement and make a profit out of it? Sounds attractive, right? So in this case, client A actually has another option, which is to hedge by establishing an opposing position in either equity CFD or world indices CFD. Here, I would like to bring up that indices will be a good hedge when you have a portfolio of index-linked stocks. So, the client can choose to either hedge fully by establishing opposing position in the same counter with the same quantity, or hedge partially by establishing opposing position in correlated instruments like the STI CFD. Now, let's talk about scenario 1 whereby client A chooses to hedge with equity CFD. Here, client can short sell ABC using equity CFD at $25 and buy back at $23. The gain from the price differentials will be $2,000, and the cost of this transaction will be $155.74 for the commission and finance charges. The net profit is $1,844.26, and as a result, client A actually can earn a profit during this bullish market movement. On the other hand, let's illustrate scenario 2 where client A chooses to hedge with indices CFD. To hedge his position, client A can short sell one contract of STI $5 CFD at $3,160 on 3rd December and buy back at $2,994 on 4th Jan. The gain from the price differential will be $830, and the cost of this transaction amounts to $64.12. In this case, the net profit from this transaction is $765.88. Now, from these two examples, we can conclude that it's actually better to hedge out your positions, especially when you feel that the market is bearish, such that you can make some profit even when prices are falling, which can help to reduce your losses. So by now, I hope that all of you have a better understanding of what CFD is and how it works, and that you are considering to use it to actually improve your performance of your portfolio. So now move on to the account opening part. For existing PoYams clients who are interested to use CFDs but do not have a CFD account yet, you can open a CFD account easily now by logging onto our platform. Go to Account Management, click on the CFD tab, and you will see an online account opening. For new clients, you may visit poyams.com.sg to open a new account. And do remember to select the CFD facility before proceeding with your application. For funding-wise, you can either do an internal transfer from your stock account to your CFD account or top up directly from your bank. For internal transfer, you can go to Account Management, go to the Stocks tab, and click on the Online Forms. Use the withdrawal form and input the amount that you wish to transfer to your CFD account. Select the Transfer into Account option, and do remember to choose the CFD account for the transfer. For funding directly from your bank, we recommend using PayNow as it's the fastest method available. For direct crediting into a CFD account, do note that you have to add CFD after your 7 digits PoYams account number. Now to the part where most of you are probably curious about, the promotions that we are offering. Now first we have the oil promotion, whereby you can get $100 petrol voucher by trading 1,000 oil contracts with us. So on the slide, you can see the QR code where you can actually scan it to learn more about this promotion. We also have our micro Hong Kong equity CFD contracts, whereby you can trade Hong Kong equity CFD from just one unit rather than the broad lot size. And this is ideal for clients who actually want to try out the Hong Kong market but have limited capital. We are currently offering this for about 100 counters, and we're actually looking forward to actually expand to offer for more counters. So if any of you actually have a counter that you want to trade, but it's not in the list of that 100 counters yet, you can actually write in or call us to actually let us know that you want to add that in, and we can consider that as well. And the next promotion that we have is a cash rebate of up to $88. And this is available for new clients and also existing clients who did not trade CFDs during the period specified. You can hop onto our website to learn more about this promotion. With that, I've come to the end of my sharing. I hope that all of you will be able to walk away with more knowledge of CFDs and are thinking of how to use CFDs to boost your portfolio. If you require more assistance, you can either call us at 6336-4564 or drop us an email at cfd@phillip.com.sg. I'll be taking any questions that you might have now, so do leave your questions that you want me to address on the Q&A section. Okay, the first question by Kenneth. What happens if there's a dividend or stock split during the period when you are holding the CFD? So for dividend, cash adjustment will be made to your account according to the dividend amount. And for stock split, your CFD position will also be adjusted according to the ratio. So this is the same as your equities trading as well. Okay, next I will address please explain the chart with calculation again on why CFD has higher risk versus stocks. Okay, let me go back to that chart. Okay, so the loss is actually amplified by leverage. So when you only have $1,000, you are only able to buy one. Okay, here let's just use the amount here lah. When you have 20,000, when you have $2,000, you can only buy $2,000 worth of stocks. On the other hand, you can actually buy up to $20,000 here, assuming that the margin is 10%. So this profit and loss will actually be based on the price movement of the whole exposure. That's why here your $20,000, if you were to open the position of $20,000 using stocks, you need $20,000, and this will actually, the profit of 1,000 will actually translate to just a 5% gain. While for CFDs, for the $20,000 position, you only need $2,000. And the $1,000 gains is actually equivalent to a 50% gain on your funds. Well, you see the drop when the prices drop is also the same. That's why the CFD is actually higher risk due to this leverage. Okay, next on the question on why do we still have to pay interest from using our own funds? So CFD contracts are traded on margin, right? So this means that you only need to pay up the margin requirement to maintain the contract, which using this example here again, you only need to pay up $2,000 for example, $20,000 contract. Hence the 18, so that's why there's an interest charge because you are only paying up $2,000. So that's why we have this finance charge. Next is can have your slides. Okay, so we do not actually send out our slides, but you can visit our website at phillipcfd.com under the education section for this video recording. So the recorded webinar will be up on our website. Next question on do we need to pass any exam to trade CFD, e.g. the CL or CKA? So for CFD trading, right, you actually need to fulfill the CKA, which is also stands for the Customer Knowledge Assessment. So you have to fill up a questionnaire, and if you do not fulfill the requirement, right, you can actually take the e-learning course that's available on the ABS SIP website. So you can actually email or call us to actually for the instruction on how to complete this e-learning if required. And this e-learning instructions are also available on our website. So you can always go and check it out. Next question is CFD stocks traded on the same platform as the usual cash stock trading platform? Yes, so you can actually trade our CFD products on POEMS 2 platform as well as the POEMS mobile platform. So it's the same platform as the one that you usually use for your equities trading. Oh, they are. Okay, next question please clarify how to make money using CFD. So if one thinks that the market is on a downward trend, what does he do? So in this case, you can actually short sell the counter by placing a sell trade, and subsequently buying back the CFD contracts to close off the position. So in this case means that you will sell high and buy back at a lower price during this downward trend, and that's how one can actually make profits in this case. Okay, next is it possible to apply for a demo account to try this out? Okay, so currently we do not have any demo account for CFD trading itself. The next question on the hedging. So does this apply to all counters or only when they offer new trades for both long and short? So you are referring to when Tencent is actually showing a long short while my Meituan is only showing a long only. So currently hedging for specific counters is available to those counters offered for a long short. But in the event, like in this case, Meituan is only showing long only, right? You can always call in to check with us if you can initiate a short position for this counter or like for the other counters as well. Okay, next question on what happens if I'm going for a long flight and my equity margin falls by 5% and I can only make the transfer in the evening. Can I pre-arrange with Phillip not to liquidate my shares? So usually we actually recommend clients to actually keep a buffer of available cash in the CFD account in case of unexpected fall in market, so that in the event if the prices are the market is really going against your favor such that the prices are dropping rapidly, right? You will not be stuck in a situation where you are suddenly get caught for having to close your positions. So we always recommend clients to keep like more available cash in their account. Okay, next is there more detail on how to trade CFD using the POEMS platform? Okay, for this, you can check out our website or contact your trading rep on how to trade CFD using the POEMS platform. Okay, since we have a bit of time, I can log on to the POEMS platform right now. Give me a second. Okay, so this is our platform, right? So for CFD trading, for more convenience, right, you can just go straight to the CFD tab here. And then here you can see that whether the counter is available for long, short, long only, etc. All the details. And then let's just click on any one of them. So this is how the trade ticket will look like. So the order type we have available is or this is for index only, is the limit, stop limit, and OCO. Maybe I'll open let me see. I'll open an equity one. So in this case, for US itself only, we have market order. The rest of the markets we don't have. But for this, we have limits order, stop limit order, trading stop order, OCO order, and contingency order. So I'll use this to actually explain this question. Can stop loss order be placed for CFD? Like how to key to buy the price I want and stop loss. So in this case, the stop limit order will be more appropriate for what you are trying to do lah. So for this, you go through the stop limit order. So assuming you have an existing position, like let's just say you bought AMD at $80 and you want to stop your cut your loss at like $60. So in this case, we will actually have to click sell, key in the stop price when you want this order ticket to be triggered. So example 70, and then key in the limit price, which is the price that you want to sell at. So for stop order, we can see that it can be valid for a day or GTD. So I hope this answers your question. Otherwise, you can always refer to our website on how to use the stop limit order. And we actually have a YouTube video that actually shows all the different order types that we have and how to use them. Or you can also contact your trading rep or contact the CFD desk. Okay, what are the synthetic orders available for CFD? Any GTC stop loss, GTD, etc. So yeah, you can see that here we have the synthetic orders we have it. So we have GTT orders for some of the markets. So you can always go to our platform and just check which one, if the particular order and the GTD is available or not. And then you just submit accordingly. The next question is, in this case, does this mean Meituan does not allow short sell positions? Yes, currently we are not offering Meituan for short yet. Yes, so I think I think that's about it. Yeah, so if you guys have any questions that you do not have right now, right, you can always just call into a CFD desk, contact your trading rep, or the fastest way is actually go to our platform website. We have a lot of information over there, and a lot of like our past webinars and explanation on like how to use the platform. The different order types are also available. Yeah, if that is all, we can this is the end of my sharing. So anything, just feel free to email in, call, or visit our website. Thank you so much for tuning in today, and have a nice day ahead. Thank you.